The fortune disappeared. How did this happen? A single founder lost roughly $20 billion in 48 hours. His family office had hidden roughly $160 billion of market exposure. It was built on secret, highly leveraged, concentrated bets structured through total return swaps and prime broker arrangements. The result was a forced unwind and at least $10 billion in losses booked by global banks. A modest trader became a private billionaire. He moved wealth into a family office. The office avoided hedge fund rules. It used swaps to mask stock ownership. It borrowed against those swaps to push size far beyond public disclosure. Growth looked like success. It also built a fragile structure. The key decision was simple and stark. The founder doubled down on a handful of names. He used total return swaps to hide that concentration. He increased notional exposure, not public equity. That choice kept the market from seeing how concentrated the risk was. It also let prime brokers extend huge leverage lines against positions they could not openly mark. Early wins made the strategy feel bulletproof. Returns outpaced peers. Prime brokers raised limits. More credit flowed. The firm's apparent diversification was an illusion. Behind the scenes, notional positions ballooned. Counterparty exposure grew without public signals. Executives and traders felt pressure to deliver ever higher returns to protect reputation and preserve capital access. Volatility began to rise in the targeted stocks. Internal risk metrics flashed. Margin triggers started to creep into view. Some banks tightened exposure limits in private. Junior risk officers raised alarms inside their firms. Those warnings did not stop the escalation. The founder and key executives repeatedly chose to maintain positions rather than shrink them. A small loss arrived and then a larger one. The first meaningful mark-to-market hit triggered a margin call. The family office patched the call with cash and securities. Tension rose at the trading desk. There were long nights and urgent calls to prime brokers. A wider sell-off produced a second wave of losses. Required collateral spiked. Liquidity windows narrowed. Investors grew anxious. Staff scrambled to find cash and reduce exposure. Pressure increased. Several prime brokers began to prepare coordinated actions. Simultaneous margin demands were issued. The firm could not meet all calls at once. Hidden exposures became visible to counterparties at the same time. Executives faced a simple truth. The structure was insolvent when forced to meet concurrent demands. Personal wealth and reputation were immediately at risk. Then the turning point arrived in a single collapsed day. An operations staffer, standing in an airport security line, made a call and realized the firm could not cover simultaneous demands across multiple banks. The caller described in real time margin notices piling up and liquidity running out. Within 48 hours, forced liquidations erased roughly $20 billion of the founder's personal fortune. The $160 billion in notional positions cascaded into public markets. Banks sold into thin markets. Prices plunged. Prime brokers coordinated aggressive unwinds. Regulators and auditors entered the scene as positions hit the tape. Transparency replaced opacity. Trades that had lived for years in private agreements now moved into public markets at the worst possible moment. Market prices collapsed under the weight of urgent sales. No single counterparty could contain the fallout. The immediate consequences were brutal and measurable. Global banks booked at least $10 billion in direct losses. Credit lines were pulled. Investor confidence evaporated overnight in related stocks and in the prime broker market. Lenders tightened underwriting across the industry. The family office was effectively imploded. The founder was later prosecuted and sentenced to 18 years. Investors and employees faced sudden ruin. Human impact spread fast and wide. Early backers who profited in the good years lost trust and capital. Employees lost jobs without warning. Families who had received philanthropic support saw payouts vanish. Executives watched reputations, built over decades, crumble. Counterparties wrote off bills that rippled through balance sheets and boardrooms. Communities that had benefited from the dynasty's largesse faced abrupt cuts. Investigations, lawsuits, and regulatory reviews followed. Banks reviewed prime broker risk controls. Regulators proposed tighter disclosure and leverage limits. Underwriting standards for total return swaps and concentrated counterparty exposures were re-examined. The episode forced the industry to confront a simple fact. Private structures can conceal systemic risk when notional exposure grows beyond the capacity of visible collateral and proper reporting. Stay with this story. Forensic review shows why collapse was inevitable once markets moved against concentrated bets hidden by swaps. Secrecy masked scale. Total return swaps hid ownership and shifted credit risk. Outsized leverage amplified losses. When several prime brokers demanded collateral at once, a self-reinforcing unwind began. Each forced sale lowered prices, which triggered more margin calls, which required more selling. The cycle fed itself until the house of cards fell. The legal and institutional fallout lasted years. Bank balance sheets absorbed headline losses. New policies constrained prime broker exposure to single clients. Due diligence standards for family offices tightened. Regulators pushed for clearer reporting where derivatives create large, concentrated economic ownership disguised by intermediaries. Market participants retooled scenarios for rapid, multi-party margin events. The final lesson is stark. Ambition and secrecy created a fragile system. Concentrated positions, hidden behind swaps, multiplied counterparty risk. Leverage turned paper gains into real losses when liquidity vanished. Trust, the unseen capital that held relationships together, proved fragile. A single phone call in an airport security line made the collapse public. The fortune disappeared, and with it a reminder. When risk is hidden, the first visible break can become an irreversible chain reaction. Stay with this story.